So if you've ever dipped a toe into the world of investing, you've probably heard the term options. And let's be honest, it usually sounds super complicated, right? You know, the kind of thing you see in the movies reserved for Wall Street pros. But what if I told you the core idea is actually way simpler than you think? Well, we're going to break it all down right now.
And look, I get it. It's a totally normal feeling. You hear all that jargon, calls, puts, strike prices, and it can feel pretty overwhelming. It's easy to just tune out and think, yeah, that's not for me. But trust me, once you peel back those layers of terminology, the concept at its heart is surprisingly simple. And that's exactly how we're going to do it. To really demystify options, we're going to forget about the stock market for a minute. Instead, we're going to use a simple story that I promise will make it all just click. So let's dive in.
All right, so to really get our heads around options, we're not going to stare at some confusing stock chart. Nope, we're going to talk about something much more real, much more tangible, buying a dream house. This little analogy, well, it's the key to unlocking this whole thing. Okay, so picture this. You find the absolute perfect house, and it's listed for $300,000. You've done your homework, and you have this gut feeling, a strong one, that the neighborhood is about to take off, making this house worth a whole lot more very soon. The only problem, you can't quite pull the trigger on buying it today. But you're terrified that if you wait, the price is going to skyrocket. You need a way to lock in that price now.
So what do? Well, you decide to approach the seller with a unique kind of proposal. It's not an offer to buy the house outright. Instead, it's an offer for a special kind of deal, one that gives you control over the property without having to own it, just yet.
You walk up to the seller and you say, look, I'll give you $5,000 in cash, right here, right now. This money is yours to keep, no matter what happens. In return, all I want is for you to give me the exclusive right to buy this house from you for exactly $300,000 at any point I choose within the next 6 months. And guess what? The seller agrees. You have just bought yourself an option.
And now, this is where the magic happens. Every single piece of that little story we just told has a direct translation in the world of options trading. So let's connect the dots and translate our simple story into those official financial terms. This is the aha moment, I promise.
Okay, this is where it all connects. See that $5,000 fee you pay the seller? In options trading, that's called the premium. It's just the cost of buying the contract. That locked-in price of $300,000, that's your strike price. And that 6-month deadline you agreed on, you guessed it, that's the expiration date. See? Not so scary. The jargon just maps right onto our story.
So you've paid your premium, you've got your contract in hand, and the clock is officially ticking for the next 6 months. From here, 2 very different things could happen. Let's walk through both of the possible outcomes.
Let's start with the fun one. Scenario 1. Your hunch was spot on. The neighborhood absolutely booms, and just 3 months later, that house is now valued at $400,000. Well, because of your contract, you get to exercise your option. You buy that $400,000 house for the original strike price of $300,000. Think about that. For a tiny $5,000 investment, you controlled a massive asset and captured a huge increase in value. That is the incredible power of leverage. But what if you were wrong? What if the neighborhood actually goes downhill and now the house is only worth $200,000? Well, here's the most beautiful and important part of an option. You have the right to buy, but you have absolutely no obligation to. So you can simply let the contract expire and walk away. Your total loss is capped at that $5,000 premium you paid. You didn't just get stuck buying an asset that lost $100,000 in value. Your risk was defined from the very beginning.
All right, so now that we've got the basic mechanic down, let's look at the 2 main flavors these contracts come in. It really just depends on which direction you think the price is headed. It's pretty simple. If you think a stock's price is going to go up, you buy what's called a call option. This is exactly what we did in our dream house example. It gives you the right to buy a stock at a set price. On the flip side, if you think a stock's price is going to go down, you'd buy a put option. This gives you the right to sell a stock at a higher locked-in price, even if the real price has tanked. A lot of people think of puts as a form of insurance for their investments. Okay, real talk for a second. Before you get too excited about all this, there is one absolutely crucial element of options that makes them fundamentally different and, yeah, riskier than just buying a stock. This is probably the single most important rule you have to understand.
Unlike a stock, which you can basically hold on to forever, every single options contract has an expiration date, a shelf life, and this date is final. It's non-negotiable. If your prediction about where the stock is headed hasn't come true by that date, the contract, it just ceases to exist. Poof, it's a hard deadline.
So here's the real kicker. With options, it's not enough to be right about which way the price is going to go. You also have to be right about the timing, because if that stock doesn't move far enough, fast enough before that expiration date hits,
Your contract expires completely worthless. Its value becomes zero. And that premium you paid, that $5,000 from our story, is gone forever. This is what makes options trading a game of strategy, not just a simple bet.
So, after all this, what's the big takeaway? Well, it should be clear that options aren't some get-rich-quick lottery ticket. They're powerful, sophisticated financial tools. And when you use them correctly, they can do amazing things, like generate income or protect your portfolio. But you have to treat them with respect.
So, if your curiosity is sparked, what's the smart way to move forward? Well, first, just keep learning. This is just the tip of the iceberg. Second, and this is a big one, try paper trading. Almost all brokers have simulators that let you practice with fake money. It's a fantastic way to learn the ropes with zero risk. And finally, if and when you do decide to use real money, please start small. Start with an amount that you would be perfectly okay with losing.
And that really brings us to the final thought. Now that you get the mechanics, the incredible potential for leverage, the clearly defined risk, but also that relentless ticking clock of expiration, what do you think? Are options a sophisticated strategic tool for an intelligent investor, or are they really just a calculated gamble? The answer, as you can probably see now, really just depends on who is using them and how.